Most people think companies grow because they make profit. But profit alone is not enough to build a large business. Behind every growing company, there is a financial strategy that most people never see. It is called capital structure. And it answers a simple but powerful question. Where does the money come from? Does a company use its own money? Or does it borrow? Or does it bring in investors? This decision shapes growth, risk, and survival. Today, we break down how companies actually finance themselves. This is Capital Clarity, a channel where we explain how money works clearly, simply, honestly. Every business needs money to operate, to hire employees, to build products, to expand into new markets. This money is called capital. But capital can come from two main sources: debt or equity. This mix is called capital structure. Understanding this mix explains how companies grow. Equity means ownership. When a company raises money through equity, it sells a portion of itself. Investors provide capital. In return, they receive shares. And those shares give them rights. A share of profits, a say in decisions, and a claim on future growth. Equity has one major advantage. There is no obligation to repay. If the company struggles, it does not need to make fixed payments. But equity also has a cost. Ownership is diluted. The founder owns less. Control becomes shared. And future profits must be divided. Debt is different. When a company takes on debt, it borrows money from banks, from investors, from financial markets. In return, it agrees to repay the loan with interest. Debt does not dilute ownership. The company keeps control, but debt creates obligation. Payments must be made, regardless of profit, and this creates pressure. At first, debt seems risky. Why borrow money if you can use your own? The answer is leverage. Leverage allows companies to grow faster. Imagine a company that has $1 million. It can invest that money and grow slowly. Or it can borrow another $1 million. Now it has $2 million to invest. If the return on investment is higher than the cost of debt, the company benefits. It grows faster. It earns more. And it scales more quickly. This is why debt is so powerful. Leverage amplifies results. If things go well, profits increase faster. But if things go poorly, losses increase too. This is the trade-off. Higher growth potential, higher risk. Companies constantly balance this trade-off. Debt works only under one condition. The company must be able to service it. If revenue drops, debt becomes a problem. Interest payments remain, but income decreases. This is how many companies fail. Too much debt, not enough stability. During economic downturns, highly leveraged companies are the most vulnerable, because fixed obligations do not disappear. If debt is risky, why not avoid it completely? Because equity is expensive. When a company sells shares, it gives up part of its future profits. Over time, this can cost more than paying interest. Also, raising equity can reduce control. Founders may lose decision-making power. In some cases, investors can influence or even replace management. So while equity is safer, it comes with its own cost. There is no perfect capital structure. Every company must find its own balance between debt and equity. Too much debt increases risk. Too much equity reduces returns and control. The optimal balance depends on industry, stability of income, growth stage, economic conditions. Stable companies can handle more debt. Unstable or early-stage companies rely more on equity. Different companies use different strategies. Tech startups often rely heavily on equity. They are risky. They have uncertain income. Investors fund growth in exchange for ownership. On the other hand, large stable companies often use debt. They have predictable cash flow. They can safely manage interest payments. This allows them to grow efficiently. Capital structure becomes especially important during economic cycles. During boom periods, companies take on more debt. Credit is cheap. Optimism is high. Growth is strong. But during downturns, the same debt becomes a burden. Revenue falls. Payments remain. This is why economic crises often expose over-leveraged companies. Here is the key insight. Companies do not choose between debt and equity randomly. They use both strategically. Debt to accelerate growth. Equity to reduce risk. The combination allows flexibility. This is the hidden strategy behind corporate growth. Even if you do not run a company, this matters. Because capital structure affects stock prices, company risk, economic stability. Companies with too much debt can collapse. Companies with balanced financing tend to survive longer. Understanding this helps you make better investment decisions. Capital structure is not just a business decision. It is part of the entire financial system. Banks provide debt. Investors provide equity. Markets connect both. This system fuels economic growth. Without it, large-scale businesses would struggle to exist. Companies do not grow only because they are profitable. They grow because they know how to use capital. Debt accelerates growth. Equity provides stability. And the balance between the two determines success or failure. Understanding this changes how you see business. Because behind every successful company, there is not just a great idea. There is a financial strategy. And that strategy is what turns small businesses into global giants.